Lynn Matheson, aka the Canadian Cottage Girl. We've got some killer content coming up for you with Josh and Ehren here from the Findlay Mortgage Team, and we're talking about CMHC's latest multifamily product. Now, there's nothing like this that's out there right now. This is a brand new product, and we're going to be breaking down the full scale of this CMHC product on this video.
There's a lot of buzz going on around right now about this product. You know, a lot of people just see the 95% loan to value or the 50-year amortizations. So we wanted to create a video around the specifics of it, why it was created, how you can go about using it. Something to keep in mind, this is a brand new product. So this product is just released for application at the start of March. So, you know, nobody's actually completed this product at the moment, but there's a whole lot of information to know about how it works, why it would work for you, and just understanding the specifics and intricacies around how you would go about qualifying for this product.
So this product, it isn't as simple as just requesting your loan to value and your amortization. It is based off of points, and the amount of points you have, it's what's going to be able to allow you to be eligible for the more competitive rates and terms.
It could be about $30,000 to $40,000 per $1 million that you'd be saving on taking the MLI Select product if you're at the maximum loan to value, which, I mean, if you're looking at a large building at $2 million or $3 million bucks, you're looking at a six-figure insurance premium that you would be saving if you went with the MLI product. So, you know, definitely things to consider when looking at your point structure as well, because
if you haven't already, subscribe to the Canadian Real Estate channel just down below and give us some love here in the comment section below. We'd love to hear from you, and make sure that you smash the like button. Guys, welcome to the channel today.
Yeah, thanks so much for having us on. I'm really excited to talk about this product today.
Absolutely, yeah. This product, I hear, has a crazy loan to value ratio that you don't see in all of these multifamily products. So let's break down the product and really dive deep into this latest CMHC product.
Sure, yeah. There's a lot of buzz going on around right now about this product. You know, a lot of people just see the 95% loan to value or the 50-year amortizations. So we wanted to create a video around the specifics of it, why it was created, how you can go about using it. Something to keep in mind, this is a brand new product. So this product is just released for application at the start of March. So, you know, nobody's actually completed this product at the moment, but there's a whole lot of information to know about how it works, why it would work for you, and just understanding the specifics and intricacies around how you would go about qualifying for this product. Essentially, this product is created around three main pillars: affordability, sustainability, and accessibility. So affordable housing has become a huge topic in Canada, especially southwestern Ontario, due to rising costs of rent, rising costs of asset values. A lot of people are feeling a squeeze right now in regards to being able to find an affordable place to live. So I think the government works with CMHC, and they're trying to push out products that are going to mandate keeping that rent at a sustainable level for the average person, while giving them accessible housing and affordable, energy efficient housing. So this product kind of encompasses all of those things to incentivize an investor to create or buy products that are at this level, or and to support the people who are going to be renting these assets as well.
Yeah, I think Josh made a good point. It's not just for acquiring buildings. This is also for construction of new buildings as well too. So again, like Josh said, I think we're in a time where we need units, and a lack of inventory is part of the reason why we're seeing these prices. And it's great to be able to turn over an apartment building, but even better to be able to actually create new units and put those new units on the market. So construction is an option with this as well too.
Absolutely, yeah. As both Josh and Ehren mentioned, with the reduced amount of inventory that we've had over the past several years, prices have skyrocketed here in Ontario for real estate. And as soon as that asset, that house or property changes hands, the new buyer is going to have a new mortgage that they're going to have to pay, which is a much higher cost to even maintain that property in and of itself, and that has a knock-on effect to the rents, and it's just increasing cost of living in general with inflation and house prices. So this product sounds like it's kind of a solution for that, or at least trying to address some of these issues that we're seeing here in the market?
Yeah, change is definitely in the air when it comes to Ontario real estate. From an investor standpoint, it's becoming more difficult to purchase assets that are cash flowing. Asset prices have increased, sometimes 30% in some areas, and it's causing the majority of investors to move away from these smaller unit buildings. So the single family homes, the duplexes, even the triplexes and fourplexes in areas like Toronto just aren't able to debt service due to the amount of debt you need to take on when acquiring these assets. So we've seen a huge shift from investors moving from this type of real estate into the multifamily commercial aspect, and there's a few reasons why. One is affordability. The average person's income hasn't increased with the asset value. So when you're looking to qualify for residential real estate, you're doing it based off of your personal income. And if you have to take on more debt, it's becoming more difficult for investors to be able to do that. So a lot of people are moving to the commercial side where you don't necessarily need to use your personal income to qualify for these properties. Now you can use the building and how it's qualifying, and this is why all these different products are coming out right now, because the average investor just isn't able to attain their goals anymore by purchasing these smaller buildings.
Absolutely. Yeah, I think we're starting to see those trends and different types of real estate strategies being talked about, and this is certainly one of them. So definitely appreciate this topic today, and I know a lot of people are asking about it. So let's break this down even further and just really explore what this product looks like and just some of the details.
Yeah, so this product, it isn't as simple as just requesting your loan to value and your amortization. It is based off of points. And the amount of points you have, it's what's going to be able to allow you to be eligible for the more competitive rates and terms. So there's two parts to this. Like I said, there is pre-existing and then there is new construction type products. So when we're looking at like pre-existing structures, again, based off the points that you're going to be able to get, it's going to determine your loan to value and your amortization. So the minimum amount of points you're going to have is 50 points. And that's going to be an accumulation of the different columns that we talked about between affordability, efficiency, and the accessibility. 50 points on a acquisition of a pre-sale building is going to get you up to 85% loan to value and going to be able to get you up to 40 years of amortization. So that's going to be your basic level. When we move up to the next points, which is 70 points, that's going to allow you to get up to 95% loan to value with a 45-year amortization. And then on your 100-point scale, you're going to be able to get up to your 95% loan to value and your 50-year amortization. Now, I think they're really gearing this product towards creating new products, because as we go through it, you will see that they are a bit more flexible on the new construction. So with the new construction, regardless of how many points, you're able to get up to 95% loan to value, but the amortization will scale in the same sense. So if at your 50 points, you're going to be at a 40-year, at your 70 points, you're going to be at a 45, and then once you get to your 100 points, you are going to be at that 50-year amortization. So again, like they are putting a bit of the emphasis on creating new units, and I do think there's a big opportunity there for investors to kind of help give back a little bit and get into that construction game.
Yeah, so there are three pillars to being able to acquire your points. Now we're going to go through each individual one, how you're going to get your points and the requirements to do that, but it's important to note that you can have a mix of these three pillars. So you don't have to have all of your points at accessibility or affordability or sustainability. You can kind of mix and match depending on your strategy, and we've been talking like decently in depth with a bunch of investors about different strategies that are going to come out of this. We think that there are some great opportunities in certain areas to be able to use this product or even be able to create a property that is sellable for this product. So, we're really looking forward to seeing what comes out of this.
Absolutely. Now, is this particular product location based, or is this something that can be used all across Ontario?
Sure, so it's all across Ontario. So CMHC is a national lender, so they're federal, so they can go all across Canada. So this product is available all across Canada for most monoline lenders. Not all banks offer this product, but the majority of them who have a large commercial arm will offer this product. So in the monoline lender world, First National is one of the better lenders that works with this. We've worked with them a handful of times on some of our larger multifamily CMHC products. So there are a ton of options in the market to be able to use this product.
Absolutely. Well, you mentioned the point structure, so let's break that down a little bit further in terms of the way that these three pillars kind of break down and how people can hit on multiple different point structures.
So the affordability aspect of this product is heavily weighted upon in regard to the three other aspects. So affordability is going to give you three different levels. So it's going to be level 1, level 2, and level 3. And these levels are based off of 50 points, 70 points, and 100 points. So you can actually get all of your points in the affordability aspect if you want. Now, the the way in which you get these points is you're committing to a 10-year term at a certain percentage of your units that are going to be rented at 30% of the median renter income. Now, CMHC releases data every single year, and that data outlines the median income in certain geographical areas. And that means that, for 50 points, for example, 10% of your building needs, or 10% of the units in your building need to be rented out at under 30% of the median income. So, and it scales. So at level 1 is 10%, level 2 is 15%, and level 3 is 25%. And these percentages of your buildings are much less on new construction than it would be on pre-existing buildings. So when you're looking to build and use this product, having 25% of your building operating under market value for a prolonged period of time isn't that bad when it comes to having all of your points in one specific category. But it is something to think about, that we've talked to a lot of investors, and a lot of them are really focused on creating generational wealth over time with their assets. Now, everybody knows that the value of your asset is based off of the operating income of that asset. So just understanding that if you are going to commit to a large amount of your building being under rented for a certain period of time, that is going to reduce the amount of forced appreciation and equity you can really create. But the new construction aspect of this is phenomenal, and to get the absolute maximum of points, 25% of your building needs to be under 30% of the median income. Now, it's important to realize that the median income changes and varies drastically depending on location. So if you are looking at building something, it might be advantageous to take a look and see where the lowest median income would be in a certain area, to be able to figure out, does it make sense for you to even rent your building under market for a prolonged period of time.
Absolutely. And I guess for an investor to decide on that strategy and what percentage they would want, they would just need to run some projections for that new construction building based off of those averages that CMHC posts.
That's correct, yeah, and those averages come out every single year. Now, one thing to keep in mind is that when you're looking at pre-existing buildings, the percentage of units that need to be rented out are weighted much heavier. So for pre-existing buildings, you're going to notice that the percentage of the units that need to be rented out are much more. So it's still in a 3-tier structure. So it's 40%. So level 1 is going to be 40% of your property is rented out. Level 2 is 60%, and level 3 is 80%. And whereas new construction was like 25% for 100 points. Now again, you can have 100 points and get all of your and get the absolute best financing from CMHC, but you are sacrificing up to 80% of your entire units being under market value and under the 30% of the median renter income for a prolonged period of time. Now, you are able to mix and match it and do that, but it's a phenomenal way to be able to get a large amount of your points, as long as you're in an area that allows you to be able to support the debt you're looking to take on.
Absolutely, and the way that this is set up, it sounds like it really wants to support investors coming in and creating units that are affordable, as well as just keeping people in units that maybe are super under rented, and a larger portion of the building that already exists staying in place, so that the investor can ultimately pull out more capital from that building.
That's correct, yeah. So a lot of the times the strategy around maybe cash for keys or stabilizing or repositioning, but this is going to allow an investor to not maybe have to go ahead and do that and keep more of the under rented units where they're at, while just being able to maintain or upgrade a certain percentage of the units in the building.
Absolutely.
Yeah, so something about reporting covenants on this specific aspect of the product is every single year you need to report to CMHC about the percentage of the building that is rented under the certain median income. So this is something that's going to be ongoing, and you're going to have to continue to prove that you are adhering to the commitment that you've made to CMHC.
Right, and so with that commitment, I guess, because the numbers are changing every year, if you do have turnover, you just have to base that off of the new numbers, or is it the numbers that you originally stepped in when you started the product?
That's a great question. I'm going to assume that it's going to be kind of fluid based off of the median income. So as the income rises, your ability to be able to keep at that level will also rise. I think obviously it's going to be due to inflation. I think the average income increases by 3 or 4%. So you're going to be able to keep up with it. Something to keep in mind though is if you wanted to, for pre-existing properties, if you wanted to commit to a 20-year term, you could actually get 100 points right off the bat. But in level 2, which would be, so it would normally be 70 points, you can add the extra 30 points for a 20-year commitment as well. There's going to be a lot of really cool investors moving into the space, I think, that are going to need a little amount of capital to be able to get into these buildings, but it's going to be a longer term play. So if you're going to focus on just the affordability aspect of your building, you're going to have to hold on to it for a really long time, but you're going to need very little amount of capital expenditure out of your pocket to be able to actually acquire these assets. So you might see a race of people just buying up buildings with little money down.
Yeah, absolutely. It sounds that way. Well, especially when we have that incentive coming in and still have affordability in mind, you're solving both the city's problems as well as working with the housing market and just trying to problem solve on all fronts. And as long as you can still win as an investor, then this strategy sounds like it could work very well.
Yeah, I think so. I think, obviously ensuring that there's affordability in our housing market is really important. You don't want to see people who can't have, who can't afford their rent. And it's really important as an investor to create affordable housing that's going to allow good people to live in your property and manage it and take care of it as well.
Absolutely. I love that. So one of the hot button topics right now is energy efficiencies. So I know that's one of the pillars here in this product. So let's break down all of the requirements on how you can get the building up to the standards of energy efficiency, or what CMHC is looking for from that standpoint.
So pillar number 2 is energy efficiency, and there's a couple different ways that you can go about taking a look at that. And really what we're looking at is increasing the baseline, or the increase above the baseline for the 2 reporting systems. So you have the National Energy Code of Buildings and the National Building Code. So if you're doing a construction building, you're constructing a new building, the proof and documentation has to be provided to CMHC 12 months after the loan request. So one of the second options is going through the insured refinance to pull the funds out to do the improvements to the building. And if this is the case, the documentation has to be reported to CMHC 60 days after the last advance of the loan. So essentially you need to have all this stuff prepared anyways. You should have it all ready to go. It's just gonna be a matter of getting it to CMHC. The last option in terms of doing the improvements is using your own funds or a non-insured, just a conventional mortgage to get that done. If that's the situation, CMHC is gonna wanna see the documentation 24 months after the last advance of the loan. So just some different reporting requirements there, getting the proof to CMHC, getting them the details. Now this is different than the affordability side, where on the affordability you have to report this every year. When we're looking at the energy efficiency, this is a one-time per request. So you get the improvements done, you show how far above the baseline is, and you only have to report that once to CMHC instead of yearly like the affordability side.
Got it. Now let's just break down kind of the different energy efficiency requirements, just in summary, that you may need to have in order to hit this kind of energy efficiency standard.
So similar to the affordability side, you have 3-point structures. It's your 30-point, your 50, and your 100-point. So we're taking a look at new construction, and again, we're looking at the increase above the baseline as per the 2 codes. So that 30-point, starting on tier number 1, is taking a look at a 20% increase from the baseline. That's going to get you your 30 points. Your next section is your 50%, and again, we're taking a look at 25% above the baseline. And then for your 100 points, we're taking a look at a 40% increase from the baseline. So again, this is going to be done via probably an engineer. It's going to go out there, taking a look, making sure that all the improvements done, measuring those against the standard baselines for both of those codes that we talked about, and what is the improvement, and that's going to be what determines your point structure. So when we take a look at existing properties, we're actually taking a look at reduction in the greenhouse gas emissions. So a 30-point is going to be awarded if you get a 15% reduction. 50% points is going to be rewarded with a 25% reduction, and then a 100-point is going to be awarded at a 40% reduction. So a little bit different from constructing, where you're constructing a building and trying to get it above baseline. When you're building, or when you're buying a resale building, you're actually looking at doing the renovations to it, or if you're refinancing a building, doing the renovations, we're looking at trying to reduce those greenhouse gas emissions, and that's what's going to get you your point scale. So as you notice, the points are a little bit less weighted here than when we're taking a look at the affordability. We had a 50, 70, 100 point scale. On the efficiency, we're 30, 50, 100. So again, I think the emphasis is around the affordability, but still, could very easily get your points, and the majority of your points, out of the efficiency and the accessibility, which we're going to talk about next.
Got it. And before we jump into that, where's the best place for people to find out the best ways to reduce the greenhouse gases in these buildings?
Yeah, so CMHC actually has a lot of product knowledge and information on their site. So we can put a link up to CMHC. They have lots of direct information on this product as well, and we'll have some little clips I think going on in the sides here, but it is downloadable off CMHC, and they have a lot of like FAQs and charts and graphs and stuff that you can take a look at. And they have some full in-depth if you want to read through all the building codes and stuff like that, or save some time, hire someone who already knows what they're doing. But yeah, it's all accessible online.
All right, so let's break down this third pillar of this product. So that's accessibility. So let's talk high level about accessibility and then break down the point system as well.
For sure. So accessibility is the third pillar of this product, and it has the least amount of points you can get from it, but it is really important when you're looking at either building or renovating a property. So there's two essentially ways in which you can successfully achieve this specific point structure. So one is creating the property, a certain percentage of the property being accessible. So it's either 15% of the entire property has to meet certain CSA obligations, or there's something called the Rick Hanson Accessibility Foundation, and essentially what they do is they offer certifications around creating accessibility in a property. And to be able to get this certification, you have to have between a 60 to 79% score. Now you can go in online and take a look at how you actually go about getting this score, but level 1 gives you 20 points, and 15% of the actual units that are considered to be accessible are required to be able to get this specific points for your building. So as I said before, there's two levels to this. So instead of having 3 levels, there's 2 levels. So the second level is going to give you 30 points, and that essentially is the same CSA standards and Rick Hanson standards, except they just have you at a higher score. So the gold standard for the Rick Hanson Foundation is 80% score, and that's going to ensure that minimum 85% of your units are accessible throughout the entire building. If you guys, this is a little bit more complex when it comes to the specific outside standards that are required for you. So I do recommend, if you are looking to get points from this specific pillar, that you take a look at at both different options and exactly what are required to be able to make your property accessible.
Absolutely. So as we mentioned earlier, we're actually going to put the link to the CMHC website just down in the description below, so you guys can go into full in-depth detail on this product. But high level, this point structure is really important to understand when you're planning your strategy around using this product. And then you can actually get into the meat and potatoes just by breaking down all of the full scope on their website.
Yeah, so something to keep in mind is that if you take a look at the accessibility and the efficiency of your property, you can get 70 points, 80 points through just that. So you don't even really have to focus on the affordability aspects of your building. If your entire strategy is to force appreciate a property and turn over tenants and try to get as high NOI as possible for your exit strategy, you don't necessarily need to focus on that specifically. It's just an easy way to be able to get your points. So if you're already going to spend the money on retrofitting your building, accessibility and the efficiency of making your building better for your tenants and for the overall cost of your expenses, it might be a great way to actually allocate capital. So take a look at all of it as a whole, make sure that it's going to fit within your investing strategy, and then execute after that. But if you are looking for somebody to talk to about the specific requirements, feel free to reach out to Ehren or myself, or an actual expert in the field in regards to your GC or some sort of engineer. They'll be able to outline how to do that for sure.
Awesome. Now, is there anything else that we should know about this product?
So one other thing we want to talk about is the insurance premium. So it is an insured product with CMHC, so you are going to have that in premium built into the loan, and there's a couple different factors that we're going to take a look at. So if the effective gross income is met, it's going to be slightly different in terms of the loan premiums if the effective gross income is not met. And again, the premium is based on that point scale. So you have the 50, 70, and 100 point. So if the effective gross income is met and you have a 50 point, you are going to have an insurance premium of 2.25%. So that's going to be built into your loan amount. At a 70 point scale, you're going to have a 1.75% premium, and then at your 100 points, you're going to have a 1%. So a lot lower than what you're going to get comparatively on CMHC's standard rental, where the premiums are actually quite a bit higher. Now, if the effective gross income is not met, the premiums are a little bit higher. So at that 50 point scale, you're 2.5. At the 70 point scale, you're 2.25, and at the 100 point scale, you're 1.25%. So a little bit higher, but again, comparative to their standard rental product, the rates are actually a lot lower. So when we compare those rates to the standard rental product, if you're looking at your max loan to value at 85%, you're looking at insurance premium between like 4.5 to 5.25%. So, on the on MLI, you were at 1 and 1.25. So at your max loan to values, the insurance premium is drastically less. So there is some advantages there, obviously, going with that MLI Select, reducing your insurance premiums if you're able to get that property in your project to match the specifications for the MLI.
Got it. Yeah, and that sounds like it's a huge savings in order to qualify previously, or with some of the other CMHC products, there is certainly, from an insurance standpoint, like a huge percentage of capital that's required, versus this, and hitting some of these point targets greatly reduces that.
It could be about $30,000 to $40,000 per $1 million that you'd be saving on taking the MLI Select product if you're at the maximum loan to value. Which, if you're looking at a large building at $2 million or $3 million bucks, you're looking at a 6-figure insurance premium that you would be saving if you went with the MLI product. So definitely things to consider when looking at your point structure as well, because if you need that 100 points to be able to save 1% or 1.5%, factoring in, well, what is that 1.5% over my $3 million loan amount? It doesn't make sense for me just to figure that out and make sure it's a little bit more affordable for my client, my tenants, than it would be for me to absorb that insurance premium.
Yeah, I just want to emphasize how important this is, and this is such a new product that not every mortgage agent, not every investor is going to understand the interworkings of this product or of products like this. So it is so important that you are working with someone who is advocating for you, who is making you aware of some of these different options. It can cost you, as you said, 6 figures if you didn't understand the full scope of this. So it's really important that you're working with someone like the Findlay Mortgage Team, or just working with the Findlay Mortgage Team, so that you have somebody in your corner backing you when you're trying to qualify for a product, whether it be for new construction or you just have an existing property that you're looking to really get the most out of. So certainly this is a great way to really fully dive deep into these products and just get at least an understanding generally from these videos, but to have someone who's actually gone through the documents, actually spent the time and broken down what the CMHC requirements are and how you can optimize your return on your investment, that is invaluable.
For sure. There's one more pillar that isn't specifically point structure, but it is very important to understand. Like, it is your personal component on the application.
Yeah.
So not everybody can just go and get this product. This is a premium product for premium properties in decent markets. Again, it is federal. It does go across the country, but understanding the personal requirements that are for these types of assets. So the average investor, this isn't their first time buying a property, especially when you're looking at this product. So you're not going in and buying a 10-unit building. And if you are, good for you, but the odds are you're not. So one of the things they're going to look at is your experience. The CMHC requires you have 5 years experience either managing or owning these types of assets. Now, if you don't, we can mitigate that by having a professional property management firm manage your asset for you. But they do want to see your past experience. How have you exited projects? Have you built anything? Who's your general contractors? How long have you been doing it for? Have you ever been late on payments? Have you ever missed any payments? They're going to take a look at your past track record with your other financial institutions. Understanding your strength as a borrower is going to be really important. The next aspect they're going to look at is capital reserves. This is a very fluid number. It's not set in stone, but what they do want to see is that you have money set aside or accessible to be able to take care of any sort of expense on a building. As many of you know, if you have a property that maybe has a large boiler system or a elevator, those are 6-figure expenses that you would have to cover. So they want to ensure that if you're buying a big building and you're getting this type of financing, you're able to actually ensure that you're going to be able to take care of these people. If you have 50 people in an apartment building and the power goes out or the boiler goes out, you need to be able to be responsible to fix that in a timely manner. So if you don't have the capital reserves to do that, that's going to be a challenge for you to be able to get this type of financing. So, it's great that you're reducing the amount of liquid capital actually needed for the purchase, but it doesn't mean I just don't have the money, I can't go buy it. You still need to be able to show you have the capital reserves to take care and manage these assets properly. So just overall strength of the buyer, guys. You know, we want to make sure that you are able to actually purchase these assets and manage these things in a efficient way. And CMHC is decently picky when it comes to ensuring that you do that. So whether that's bringing on a investor or bringing on a partner with you that has the adequate net worth available or the accessible large line of credit available to support the debt on something like that. You know, a lot of people who are looking to move up into this space do find partners who are qualifiers or who can help them with the strength of the overall personal net worth or application.
Yeah, there are minimums on the personal net worth too. It is 25% of the loan amount requested, so it is something they're going to take a look at, down to a minimum of $100,000.
Absolutely. Is there anything else that we should know about this product or qualifying for it?
This time frame, as Erin said previously, it does take a significant amount of time to go through the application process. Now, I did hear that CMHC has tried to implement more people and support staff to help push these applications along faster, but currently right now we're looking at like 3, 4, 5 months, depending on how the application process is going at the moment. So just keep in mind this isn't something that's going to be quick, and there are lenders out there that do offer transition financing. So if you are looking to acquire a property with this, everybody knows it's not viable to be able to push a closing out 4 months or 5 months. So if your property does work with this type of financing, a large lender will allow you to transition into a purchase and then kind of bridge it into maybe a 6-month open term and then move you into CMHC financing. You probably will need the capital up front to meet the minimum down payment requirements for that bridge financing, but you'll be able to kind of absorb that back in when you do move into the CMHC at a later date.
Absolutely.
There are some lenders too that when you are doing that bridge, they may allow you to go up to 85%, so you can get that 75% first, tack on a second mortgage afterwards, private second. Just one thing, I know we talked about it, is CMHC's values do tend to come in a little bit lower than where you're suspecting. So if you do get that bridge at 85% with the private second, just be prepared that if the value does come in less and there is enough fund to take that out, that is a cash out of your pocket type situation just to pay that down and get the values in line. But like Josh said, there are bridge options available. You can add on an 85% second as well to help out. Absolutely.
Now, this is a very kind of unique product in the fact that there are point systems and a lot of different dynamics to account for. So let's just summarize the key points that someone might need to know to really step into this product, or why you should maybe consider working with someone who understands this product so that you can optimize your returns.
Yeah, key points. The MLI Select, it is really geared towards, or it really does seem like they're pushing investors towards building those new units. They do have a lot more flexibility on the points, and they are a lot more efficient on the point dealing out on the new construction type stuff. But again, available for both pre-existing sales and on new construction type buildings. It's going to be based on across 3 pillars. You have your affordability, your energy efficiency, and the accessibility factors. Your ability to get your top loan to values and your amortizations is going to be based off the amount of points. So to get your 95% loan to value and a 50-year AM, you are going to have to achieve that 100 point scaling system there. Again, a bit more competitive on the rate premiums compared to the standard rental product that CMHC has. Overall, compared to just a conventional type financing product, you're getting the better loan to values, you're getting up to 95, you're getting a 50-year amortization, you're getting a lower interest rate. So, overall, it does put you in a much more competitive project. There are just some criteria that you do have to be aware of, especially on the affordability side, because like Josh mentioned, there is a 10-year expectation for you to follow those keeping the rents below that market value. So, keep that in mind, making sure that, hey, do I want to be able to follow all these criteria? Is this something that I want to have in my project? If yes, this is going to be a great project. It is going to help a lot of investors. If you are someone who likes to use your property as an ATM, every couple of years you turn it over, you take out that increase in value, and you have that equity takeout, CMHC is not going to be the option for you. CMHC is this long-term takeout type financing, or almost set it and forget it type financing, you're not going to be constantly refinancing. It's very expensive. It's meant to be rigid, and that's what that product is there for. So again, sit down, let's talk about what your goals are, which product is going to be the best product for you. It doesn't mean you can't go into CMHC eventually, but if you're looking to acquire and BRRRR and turn that over, you're going to have to get that done conventionally or private, and then look at moving into CMHC down the road.
Absolutely. Now, what's the best place for people to find you to reach out about this product or some of the other products that you have?
For sure, yeah. Our contact information is going to be down below, guys. So if you guys want to hit us up on our social media, our personal phone numbers, our email addresses, it'll all be available for you guys to reach out at any time. We're pretty available the majority of the time, so feel free to give us a call. We're happy to help.
Absolutely. Now guys, if you haven't been tuned into this channel, make sure that you're subscribed and that you turn on the notification bell so that you don't miss out on a single drop. But these guys are actually on the channel for Findlay Finance Fridays regularly all of the time, so make sure you check out that video and hop over to their own YouTube channel, the Findlay Mortgage Team on YouTube. You can also follow them on social media, and their contact details are just in the description below, as Josh mentioned. So stay tuned for some more fantastic mortgage investment friendly content, and make sure that you throw us some love in the comment section below, smash that like button, and we'll see you guys on the next one. Peace.